Hersh Shefrin, Beyond Greed and Fear, Understanding Behavioral Finance and the Psychology of Investing. In Beyond Greed and Fear, Hersh Shefrin challenges conventional wisdom about financial markets efficiency and delves into behavioral finance and the psychology of investing. This summary illuminates how emotions such as hope, fear, and greed lead to flawed decision-making. Throughout the book, you'll learn about three major themes in behavioral finance: heuristic-driven biases, frame dependence, and inefficient markets. The book also provides real-world examples of how these ideas manifest in retirement planning and corporate management, as well as the strategies of successful investors and the failures of inexperienced ones.
The fallacy of efficient financial markets. Financial theory teaches us that efficient markets price investments to their true value, given the abundance of information available and willing buyers and sellers. However, the school of behavioral finance disputes this theory, which studies the intersection of investment and psychology. Behavioral finance reveals that investors act on emotions, leading to flawed logic and unrealistic expectations. The imperfection of human perception often controls decision-making, and many investors end up making bad choices. This is not to say that studying behavioral finance will make you rich, but it will help you recognize money-losing, emotionally laden patterns and avoid them. Lastly, the most profitable strategy for individual investors is to avoid trading stocks and stick with indexed mutual funds. The psychology of investing. The book challenges the widely held belief that greed and fear motivate investors and instead argues that fear and hope are the primary emotions driving investment decisions. To gain a deeper understanding of behavioral finance, the book discusses three themes: heuristic-driven bias, frame dependence, and inefficient markets. Heuristic-driven bias refers to the rules of thumb investors use to make decisions, which are often based on personal views and experiences. Frame dependence is the way in which investors frame a problem and make decisions based on various mental and emotional factors. Inefficient markets arise due to investors' imperfect decision-making, which contradicts the theory of efficient markets that claim investments are priced to their true value. The book provides examples to illustrate each theme and shows how these factors contribute to complex, illogical emotional factors that motivate investors. Pitfalls of investors. The pitfall of short-sightedness, overconfidence, lack of self-control, and denial in investors often leads to poor decisions and lackluster returns. These principles apply not just to retirement planning but also to individual investment choices. The tendency to search for confirming evidence and ignore disconfirming evidence can have severe consequences. Get-Evenitis. Holding on to losing investments in the hope that they will eventually bounce back is a common mistake made by pros and novices alike. This behavior, known as Get-Evenitis, can be particularly damaging for individual investors. Successful investors know how to cut their losses quickly, whereas those who struggle to let go of their losing investments find it hard to face their poor decisions and may become prone to hubris and overconfidence. Nick Leeson, former manager of a Barings Bank subsidiary, made rogue trades to hide his losses but ultimately caused the collapse of a 232-year-old company due to his inability to accept losses. However, it's not just rogue traders who fall prey to Get-Evenitis. Corporate executives and individuals like former Bear Stearns & Company chairman Cy Lewis and community college instructor Melvin Clare have also found themselves unable to let go of losing investments. The bandwagon effect, or the belief that the crowd must know something, and misery loves company, can exacerbate Get-Evenitis, especially for individual investors. The takeaway from this phenomenon is that cutting losses quickly is crucial for long-term success in investing. Investment pitfalls. Investment decision-makers, who blindly follow expert advice, often fall into typical cognitive biases that lead to financial loss. They overlook sentiment-based risks based on psychologically induced errors. Inadequate saving, the blame game, and gambler's fallacy are some errors that investors must avoid. Investment decision-makers who follow expert advice blindly often fall into the trap of cognitive biases that lead to loss. This strategy is known as the blame game, where investors credit themselves for a wise investment decision if the expert's pick works out, but point fingers if they incur losses. Robert Citrin's bankruptcy of Orange County in 1994 is an example of this exercise. His reliance on Charles Clough, a Merrill Lynch strategist, led to losses, and he shifted the blame to Clough. Inadequate savings are essentially a self-control problem caused by the temptation to consume now, leading to sentiment-based risks from psychologically induced errors. Behavioral finance highlights the significance of abnormal profit opportunities while overlooking behavioral errors that lead to loss. The gambler's fallacy is a common mistake that claims investors, including Robert Citrin. He forecasted a recession in 1988 because the economy's expansion was longer than average. This forecasting is basing a decision on too few facts, and investors often rely on useless information like technical indicators, leading to the gambler's fallacy. Once investors' judgments prove to be erroneous, hindsight bias creeps in, justifying their decision and reasoning that led to losses. Investors who wish to avoid such errors must recognize and avoid sentiment-based risks and avoid inadequate savings, the blame game, and gambler's fallacy. The market inefficiency of closed-end funds. Closed-end funds offer an interesting perspective on market inefficiency, especially when compared to open-ended mutual funds. While open-ended mutual funds offer an unlimited number of shares and are typically priced at their net asset value, closed-end funds have a fixed number of shares and often sell at a premium. However, 6 months after their initial offering, they trade at a discount. The size of this discount can change over time and disappears when the fund is liquidated or switched to an open-ended fund. The unique characteristics of closed-end funds can be attributed to extrapolation bias, the practice of betting on trends. Country-based funds provide a clear illustration of how sentiment and extrapolation bias can lead to unpredictable price swings. In the case of the Germany fund, the price of its shares soared after the Berlin Wall fell but returned to normal shortly thereafter. Researchers also discovered that articles in the New York Times about a particular country could cause prices in closed-end funds specializing in that nation to rise or fall drastically. These observations challenge the notion of perfectly efficient markets, exposing the limitations of efficient market theorists.
Behavioral finance reveals that investors are prone to flawed decision-making due to emotional factors, including heuristic-driven biases, frame dependence, and inefficient markets. By scrutinizing these concepts and their examples in the real world, Beyond Greed and Fear offers vital insights into how investors can recognize and avoid these patterns. While behavioral finance cannot guarantee wealth, it can help people identify and correct money-losing habits, improve their decision-making, and ultimately develop a more mindful approach to investing. This understanding of behavioral finance is crucial for investors who seek higher returns while avoiding costly mistakes. In today's complex financial landscape,